What's going on, everybody, and welcome to bootcamp day number, I think this is going to be bootcamp day number 20. I am recording this in advance, but today we are going to be going over fair value gaps part 2. I'm going to be doing the first half where I'm going to be discussing how you can identify trades using fair value gaps. If you guys did not see part 1 that I uploaded yesterday, I highly suggest you go and watch that one first. That link will be down in the description. But like I said, I'm going to be doing the first half of this video, and then I have a special guest coming on for the second half of this video, discussing how he uses fair value gaps in his trading strategy. But real quick, before we hop into it, as always, make sure you guys do that daily check-in. Comment down below letting me know that you're still rocking with me all the way until the end of this boot camp. While you're at it, also make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But let's hop right into this. All right, so as discussed yesterday, you can identify fair value gaps on many different time frames: 5 minute, 1 minute, 2 minute, 3 minute, 15 minute, 30 minute, hour, 4 hour, etc. Right? They are literally everywhere. So as far as actually trading these areas of interest, let's just go ahead and let's find one. We actually had one right here in the morning. So if we break it down to a 5 minute time frame, we can actually see right in the morning we had this high point right here, this upper wick, a very strong aggressive move away from the area, and then a retracement into it. So this is going to be our fair value gap. Remember, we're looking for price to trade into the area, and then from there, what we want to look for is we want to look for an entry. So typically what you can do is break it down to smaller time frames, because this is a 5 minute fair value gap. You can break it down to a 1 minute or a 2 minute and start looking for bullish price action. We can also look at the moving averages. If we have moving averages inside of the fair value gap, that gives us a better understanding of, okay, we should ideally be looking for price to come, down to this level and have a reaction, or down to this level and to look for a reaction. Or what you can do is actually take your Fibonacci retracement and you can measure the difference between the first candle wick all the way up to the second candle wick. And then from there, what you can look for is for 50%. So halfway through that fair value gap, that is where you can start looking for an entry. Now, depending on how large that fair value gap is, if it was a lot smaller, let's just say, if we were to shrink this here to here, okay, that's a much smaller zone that we could use. So at that point, I would just be looking for price to dip into it and then have a bullish reaction out of it to then validate the entry. But if we're using a wider fair value gap, this is exactly what I'm going to be looking for price to confirm an entry. Again, I'm going to be measuring between those 2 points to identify where's the 50, so the halfway mark between it. And then also you can use those moving averages to also identify an area of interest for an entry. If you were to get long in this area right here, either at the 50 or as price reacted off of that 5 minute 21 EMA, your stop loss would have been right below this fair value gap. So if price started breaking below, you would have stopped out. And as you can see, price made a move right back in the high a day. So that's just one example right there. If we were to look, let's see, we didn't have any good ones to the downside today. Let's just head on over to yesterday, see if we had a good one. Okay, so this was a little smaller of a level. So as we can see, and personally, I wouldn't be taking a trade like this. I just want to show you guys an example. But as we see, we had this large move to the upside. Personally, if I would have been trading a fair value gap like this, I would have been watching this one right here. This was the very first one. You can just see that we literally had a bunch of them. But again, I just want to show you guys this example right here. So as we can see, price ended up having that fair value gap right here. Price dipped down into it and then got bought right back up. Again, you can use smaller time frames, 1 minute, 2 minute, 3 minute to identify an entry and look for bullish price action in that area. And as price came outside of it, you could have gotten an entry and caught a nice little scalp to the upside. But also, if we just go ahead and measure the difference, I'm sure it did 50%. Because yeah, pretty much right at that 50%, got bought up and then pushed to the upside. So maybe you got the entry as it came outside of it. Maybe you got the entry right at the 50% retracement and your stop loss was right below here. Either way, you could have identified an entry for a nice scalp to the upside. Again, that's personally not a trade I would have taken, but here's another one right here that you could have traded to the downside because the market has been pretty weak. So as we see, difference between this wick low, strong aggressive move down, and then we have this opening wick, or actually the opening of that candle right here. We do have a nice little fair value gap that we can then watch. So again, there's a couple of different ways that you could identify an entry, and this is a little smaller of a zone. So what can you do? You can measure the difference, which is going to give you that 50% right there. You also have the 8 EMA and 21 EMA both lining up around this area right here. As price started to come up and started rejecting, again, watching the smaller time frames. So 2 minute, 1 minute, whatever you want to use, you could have watched that and then identify some bearish price action and then get short with your stop loss right above this high. Or if you waited until the candle closed, it's just your risk would have been wider in this scenario if you waited for the candle close. But if you broke it down to a smaller time frame, you can identify a earlier entry. So if you got short up here, your stop loss was right above this high. And as you can see, price made a nice flush to the downside. Now, again, using multiple confirmations, this is where the halfway mark was in the fair value gap, but also at the same time, if you took pivot high down to pivot low with an actual retracement, you can see that's where price ended up pulling right into. So you had a lot of confluence in this one area, the actual 50% retracement, the midway point of the fair value gap, 8 EMA and 21 EMA. So a lot of confluence in that one area confirming the trade. Let's see if we can find another one. Let's go ahead and, I mean, you could have used this one. That one's not the best, but I mean, there was a nice little fair value gap there. You can see price kind of just held in it before it pushed away. Let's find a different scenario. There's one right here, actually. So if we just go ahead, same thing, high, low, we can see that price dipped into that fair value gap and got bought right up out of it. So again, you could have done the same thing. You can measure the difference between these 2 points, and you can see right at the halfway point, that 50 is where it got bought up. Price dipped into it, got bought up here, got bought up here, could have confirmed an entry, either or, right? If you wanted to buy here with your stop loss right below this low, or as price started to come out and confirm, again, breaking it down to a smaller time frame, you can identify an earlier entry. At the same time, we had a falling wedge, which is typically a bullish continuation pattern, which again, piecing everything together, you have a lot of confluence in that one area, which could have led to a low risk, high probability trade. And then from there, you can see price continue to the upside. Let's head on over right here. Actually, yes, that is a very good example. So right here, it looks like this was in the overnight session. We can see that we had this low point right here during the London session. Very large reaction to the upside, and then price comes down and it just dips into the very beginning of that zone. Again, sometimes that's going to happen. Sometimes it will retrace the 50% or even deeper into the zone. That's why we want to watch price action. So as we see, price immediately came down, got bought right back up. Again, breaking it down to a 1 minute or 2 minute could have led to an entry up at this spot right here. And price was able to give a nice little pop to the upside, pull back, new higher high, higher low, and then a higher high before finally falling apart. So that's another good example right there. Let's see if we can find, almost hit that one right there. Here's a good one right here, actually. So go ahead and draw this. You can see that we had this low right here before a strong aggressive move to the downside at 8:30. Again, setting up for a fair value gap. So you would just take that low to that high point right there. And then what you could do is you can measure in between the two, get the 50%, which ended up lining up right here. At the same time, you have the 8 EMA and the 21 EMA inside of that zone. Again, breaking it down smaller time frames, 1 minute, 2 minute could have led to a sniper entry inside of this area right here. Either way, you can see that the price action did confirm. Just if you enter down here, the risk was, again, significantly skewed against you. So if you got short up here, your stop loss was right above that fair value gap. Use the smaller time frames to identify your sniper entry, and you could have gotten short and taken advantage of that move to the downside. So that was another example right there. Here's another one right on over here. So actually there was 2 of them right in this area. So let's just go ahead and take a look at this one right here. This one just made a deeper retracement into the fair value gap, but ultimately it ended up failing. You see price tried to push up, large sell-off right here, came up, set a lower high, and then ultimately rolled over, started flushing to the downside. Then after that, in the overnight session, there was another fair value gap. So we take this low down to that high point right here. You can see price traded to the very high of that zone in the overnight session and then ended up selling off. Again, if you were able to identify an entry off of this bearish price action, your stop loss was right above this high before price continued lower. Here's another really good one. So as we see, price starts flushing to the downside. If you start piecing together liquidity sweeps, and I think I'm going to have a video combining liquidity sweeps into fair value gaps, because that's a strategy that I personally really like, is when price goes and it sweeps liquidity, has a strong move in the opposite direction, and then sets up a fair value gap. That is what I have noticed is a very high probability setup. So in this scenario, maybe there was a liquidity sweep. I don't know what day this ended up being, but if this ended up being a liquidity sweep, it took out the liquidity, had a nice strong move to the upside, and then retraced right into that fair value gap, which set up for a high probability trade to the upside. So again, here's the fair value gap, very bullish price action right out of that level. could have gone long with a stop loss right below this low. This would be a scenario where I'm actually looking for the candle to close outside of the fair value gap, just because you can see we had a really strong move to the downside previously. So we come down, we have bullish price action, buyers buy it right up. You could have gotten long, stop loss right below this low. And as you can see, price made a really strong move to the upside right after that. So I'm actually going to make a video on the liquidity sweep into the fair value gap. I just got to find a bunch of examples for you guys. That way I'm not searching forever to show you guys. So maybe next week I'm going to try to take a bunch of screenshots of liquidity sweeps into fair value gaps, and then we can go over it and I can show you exactly what I am looking for when it comes to that. But that is how you're going to identify trades using fair value gaps. Again, what we want to identify is an area of interest. Where can price likely retrace to? You can use the Fibonacci retracements to find the halfway point in between that fair value gap. Use the moving averages as well to your advantage, because the more confluence you have inside of a fair value gap, the higher the probability the trade is going to be. So when price retraces into that fair value gap, if you're looking for a short, you want to be looking for bearish price action, bearish hammers, gravestone dojis, bearish engulfing, long upper wicks with heavy volume. That's what you want to look for to confirm the entry. If you're looking for a retracement for a long entry, you're looking for bullish hammers, bullish engulfing, dragonfly dojis, long lower wicks, bullish price action in that area of interest to then confirm the trade. So this is going to wrap up part 1 of this video. Next, we're going to have our special guest for part 2. But if you guys did find value, definitely make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But let's hop into part 2.
What is up, everyone? Welcome to part 2 of showing how to use fair value gaps. I know you guys learned from Brandon in the last one. Today, I'm going to go through my strategy, how I use fair value gaps, and also just honestly, fair value gaps to me is just like another tool in the toolbox. I trade primarily supply and demand. However, in current market conditions, it's been really hard to find good moves off of supply and demand, at least in my trading. So using fair value gaps has helped me make more trades in current market conditions and honestly just get better results. So I hope this video can help, and I hope this series that Brandon is doing can help you become a better trader. So let's just get into this right now. So today, actually, we're going to look at current price action. You can see it's still live. What time is it? It is 2:21 p.m. here on the East Coast. So we're still trading in session. And today we took a nice trade, actually using a fair value gap. So one thing that I've implemented in my strategy is using pre-market lows and pre-market highs, and also pre-market support and resistance levels. So to get my tool out here, let's get this drawing tool. Boom. All right, so we had a lot of resistance in the pre-market. We touched once, twice, 3 times. Up in this level is 446.6 to 446.7. So I had that marked out as a key level for this morning. Again, I used the pre-market low, so I marked that one out as well. I also come up here and mark out the pre-market high. As you can see, that's marked out. So I have current levels marked out, as well as if I go to a higher time frame, I come out here and I'll pick up supply and demand levels. I don't have any much charted on my charts right now because of the chop and the range we are in. That's why I don't have many supply or demand. However, this is why I've been using the fair value gaps, because the supply and demand hasn't been working in my strategy lately. So going into the 5-minute time frame, we have those current levels marked out, and we see a rejection off of that resistance, a nice push down. And I like to use fair value gaps as a point of, especially for new traders. A lot of traders say with my supply and demand strategy, they fail to be able to execute because they get nervous. They don't want to just buy puts on supply because it's just tough supply, right? They get a little nervous. They don't know how to enter the position. Well, I always say, well, you can wait for the rejection to happen on the supply and then find the fair value gap to find your entry. And this is the same instance, right? We see price action reverse off our resistance, come down, and then form a fair value gap to give us an entry to capitalize off of this move. So looking at the price action, let's get our little rectangles out here. Price action rejects off that supply and forms a decent fair value gap from here. Oh, sorry, not from here. Sorry. From here to here. Boom. Nice fair value gap. That being said, why is that a fair value gap? Really quick, I'm sure Brandon already touched on it, but the neighboring wick candle comes down to here. The next neighboring wick candle is right here. Therefore, it leaves an inefficiency in this candle right here. Now, the theory is once price action gets pushed back into this inefficiency in this candle, sell orders will get filled, continuing this push to the downside. And we have multiple reasonings, right? We have a reject off of resistance, a fair value gap retest. But what do you notice here as well? Another thing I put into my strategy are the 9 EMA and the 20 EMA. So price action goes and retests the 9 EMA, fails that 9 EMA, gives you a perfect entry. Let's see. Let me just get this little oval tool. Gives us a perfect entry right here to go short. And we can go short here and capitalize off this nice move down. Now, with my strategy alone, what I'll do is once I see this and honestly take my trade, my stop loss is going to be a candle close above this fair value gap. So really sets me up for good risk to reward. And a lot of people get so, especially newer traders, they get so, I would say like mad, or they get FOMO when they miss this nice candle move down and they think they missed the move, when you could just wait for a fair value gap to form and catch it, honestly, at a perfect entry. So you're not really missing out, but you're being patient and waiting for a sniper entry, as Brandon likes to say. So that is really how I use fair value gaps. I love for the EMAs to correlate with this gap, and also having another level to give me confirmation, right? I had this resistance level, gave me confirmation to go short. If I have a supply or demand level, that is ideal. So that's really how I use them. I use them to the upside and the downside. I would have to go through my recent to find a upside one. Let me see. Let's go to the 5-minute 180 day here to find an example. So here's one right here. It's kind of like, extended, but it's still the same theory. So let's go. Boom. Remove this really quick.
What time frames do you use when you're identifying these FVGs?
I only use the 5-minute time frame personally. I know you have experimented with the 2-minute time frame, the 3-minute, I believe. And I don't think that's bad. I think honestly, people ask me, can we use it on the 15-minute? Can we use it on the hourly? I mean, sure, why not? It's all dependent on how, what system you build and what works for your strategy. I feel like for me, I hated trading the 1-minute, and I didn't really like trading the 2-minute. So I feel like the 5-minute gave me the best possible entries, and also I think a little more patience for the move to actually work out and happen. So in my case scenario, I like using the 5-minute. Here we formulate this big fair value gap on this candle. We draw it out here. So why is this a fair value gap? Well, we had this impulse move to the upside. This neighboring candle wick comes up to here. This neighboring candle wick comes down to here, formulating an efficiency right in this little zone in between this candle. See where the body candle is? That's where the inefficiency is. We would have to assume that there's orders being left there and ready to get filled to the upside. This next candle comes down, pushes down, but what does it do? Also touches these EMAs, makes a nice move up. And that's exactly what I wanted to touch on, because the EMAs also gave you another sense of confirmation, a little more conviction, and then we see a nice move up. So again, this is the ideal entries I look for when I'm trading in between zones, or even if I didn't get the entry off the zone, this is what I'm looking for, and what has worked in the last 5 to 6 months, especially in these market conditions. So not only have I seen success with it, Brandon's seen a lot of success with it. I know we've been working on kind of together with this type of strategies, and as well as the Team Bull members have found a lot of success with it. I've taught it in the previous masterminds, and yeah, we found a lot of success as a group. So I think one thing in detail that this strategy does well with is that it gives you a really, really good entry. And when it does fail, your stop loss a 5-minute candle close out of this zone is primarily going to be a small loss comparable to your winners. Like you see here, if we had a 5-minute close down here, okay, it's a decent loss, right? It's a decent loss, even if the candle closes all the way down here. But again, we entered right here, or let's say we got, okay entry. Let's say we entered right here. We still had this massive upside to capitalize on, right? So either way, we're setting ourselves up a good risk reward. And I believe that it's just one of those strategies where if you're a person that struggles to enter, you have so many ways to have conviction in this trade that you can feel a little more comfortable hopping in, if that makes sense. What do you think about that, Brandon?
I like it. And yeah, we're also going to be doing a video on your channel, so make sure you guys check that one out. I think you'll have it out by the time this video goes up, but pretty much combining fibs and the fair value gaps together. But again, it's just another area to identify where can price potentially retrace to. Like, we don't want to try to chase those huge green candles, because at that point, the risk to reward is significantly skewed against us. But being able to identify where these retracement zones are, like the one that you have drawn on the screen, gives us a fantastic risk to reward, because like you said, all I had to do was break below that little red rectangle and we were stopped out of the trade. And then from there, we push all the way up into, what is that, 446.6. So I personally really like it. And then if we have other confluences, moving averages, VWAP, Fibonacci, previous supported resistance, etc., just makes it so much higher probability.
Yeah. One other thing I would like to say is, like you said, you put it with fibs or you put it with supply and demand, like I do. While we're not getting those supply and demand tests every single day, especially with the way I trade them. I usually use the 1 hour to the 4 hour supply or demand zones. That's why you see my zones be so far out, because I'm using the most prominent and the higher time frame levels to give us the bigger moves. And if you're scared to enter off of those, if you're nervous, this is a great strategy to give you some extra conviction, because I know one of the biggest problems with traders in general is they formulate this plan in the pre-market. They write it in their notebooks and they go attempt to trade it when the price action's live, and then they don't do it, right? They don't execute. They don't have the confidence to do it. And then they see the move actually work out in their favor, and then they end up sizing up, entering the position when it's wrong, and then getting absolutely screwed. And it's all because your mind is playing games with you. You don't have the right confidence. So I think this is just one strategy that can really build that confidence and build your system along with the execution. All in all, I know Brandon uses fair value gaps pretty much the same way as I do. He uses the fibs to get really good levels for the most part as well, and I use support resistance and supply and demand, really the main core of my strategy. I think the past 6-7 months have been a little hard for me with supply and demand levels, so I had to adapt my strategy a little bit and implement fair value gaps and other strategies. And this is just one where it's worked so well, and Brandon's even said the same thing. It's worked really well in his strategy. So if you're struggling, just know, like, even if you're a great trader, even if you are the best trader in the world, everyone needs to adapt to current market conditions. So doing this boot camp and going through this boot camp that Brandon's doing can help you adapt and help you, build better strategies for all market conditions. And if you're watching this, you're taking that next step to success. So thank you for having me, Brandon. I really appreciate it. And yeah, thank you guys for watching. Peace out.